All right, welcome to the seminar. My name is Clay Cathcart, and I am an enrolled agent with the IRS, and I also am the president of Listo Tax Solutions. The reason why we're doing this seminar today is we really want to help your business grow, especially in this down economy. And the whole idea of this seminar is to make sure that you can apply some basic principles to your current operations that will increase your revenue and also protect your business. And really that's what we're looking at today, is how to increase your income and how to avoid IRS audits, because those are two things that are going to be critical into keeping your business running smoothly and to keep it there for the long term. So for example, in this economy, it is becoming increasingly necessary to find ways to increase revenue. There are different ways of doing this. You can increase your market exposure, you can change your messaging, and you can bring on new product lines. But all those things can be difficult. And while those methods could be effective, they take time to implement. And this causes a delay in receipt of revenue. And in some cases, those methods, they may not even work. And so really what we want to do is give you something that you can apply right away. And it can be very effective. And that's what this seminar focuses on. We're focusing on current solutions to increase your income in a rapid fashion. The following techniques examine operational cost savings that tend to be overlooked by businesses. So they're just very simple methods that we want to implement, and they've been overlooked in the past. So let's look at a comparison first before we even get started. If we look at increasing your income or increasing sales, that's what we want to look at, these two comparisons. To increase your income, there is no need to bring in new customers, no need at all. To increase sales, new customers, they're generally necessary. You're going to need new customers most likely to increase your sales. To increase your income, there are no increased marketing costs at all. And to increase your sales, there's possible increased marketing costs depending on how you decide to increase your sales. For increased income, there's no additional sales staff necessary. For increasing sales, there's a possibility additional sales staff is going to be necessary to increase more sales. And there's no stressful sales pitch to give if you're increasing your income. And if you're increasing your sales, a sales pitch is going to be required at some point, whether it's to the bank or to your clients. And then the increased income, an in-depth look into operation and efficiencies is required. So that's something that you're going to have to do with increasing your income, is you're going to have to really look at yourself and decide how can you operate more efficiently. To increase sales, you're going to have to come up with brainstorming for new product or marketing required. So if we just look at these two comparisons, again, nothing wrong with focusing on increasing sales. Nothing wrong with that at all. But if we look at these two comparisons and we decide to increase sales, and that's the method we want to go, there's a lot of things that we need to do, and it's going to be very expensive to do those things. Rather, if we look at increasing our income, now we're not going to have to do all those techniques to increase our sales. We're just going to have to look at our current operations and our current efficiencies. And that's a big difference in actually operating your business as to producing more sales. With producing more sales, you don't even know if you're going to be able to bring in more clients based on that new method. There's no guarantee that this is going to work. If you look at increasing your income by actually looking at your expenses, then you know that that method is going to work, because you're going to see an immediate result. The first step is we need to focus. And we need to focus our energy on increasing income. And the primary key to increase income is to focus on the operational efficiencies of your current business model. Once you've achieved the optimal efficiency, your bottom line is going to increase. That's just going to happen naturally. Some businesses, they fail to have a good understanding of their cost of goods sold. And that's going to be the key component that we're going to be speaking about today, is really your cost of goods sold. Some businesses believe they have income and expenses, and that's it. But the cost of goods sold is one of the most important facets and the most important thing we're going to focus on today. We're also going to be talking about expenses as well, but the cost of goods sold is the key component that we really want to focus on. This is the starting point to increasing your business income. Small changes within your cost of goods sold are going to make large changes to the bottom line. That's just natural. And you're going to see that in some of our examples. If you make just a small change in your cost of goods sold, it's going to have an effect year after year, and it's going to increase your bottom line. After your cost of goods sold have been addressed, it is then necessary to evaluate all expense accounts. So we're not going to just decide, okay, we're only going to focus on cost of goods sold and then we're done. A good business manager is going to look at your cost of goods sold, and then they're also going to look at all expenses line by line after that's been done. But we really want to start with cost of goods sold because it's going to have the largest impact. So now we've got our focus in the right spot, we need to analyze the income statement. Your income statement could also be called a profit and loss. It just depends on your accountant or how it's being done. So this is the same as a profit and loss. It's just the accountants generally call it an income statement. Bookkeepers call it a profit and loss. And if you're not sure, sometimes it's profit and loss. But really it's called an income statement. And this is the first thing that we really want to focus on. So again, we talked about the cost of goods sold. So our first step is to analyze the income statement. A good starting point is to review the expenses that comprise the largest percentage of income. Lowering the cost of these expenses will have the greatest effect. So if we look off to the right here, we pull up our income statement, and on that income statement, we actually look at what is the greatest percentage based on the cost. And as we can see in here, our inventory is running 50.7%. So that is one of our greatest expenses compared to income. So this is a real simple report to run. Depending on your program, you actually just run the report and you say, what is my percentage of expenses compared to income? And that's where we're going to start. So we're going to look at the inventory because it's 50%. Also, our wages are 19%. And then as we go down through the expenses, we can see our payroll is 10%. So where would we want to start? Exactly. We're going to want to start with the inventory because it's the largest percentage. If we can save anything in there, even just 2%, it makes a huge difference to the bottom line. So it is best to start with the cost of goods sold, which we talked about. Remember, that cost of goods sold area is where we want to focus, and here it is. That's our cost of goods sold. It's expanded out. We can look at it in more detail. And once we're done with this, we can then start going through the expenses down below. But let's look at this first. We talked about it. Inventory is the greatest percentage. That's what we're going to focus on. Materials and supplies is only 4.7. We can save money there. There's no reason to overlook it. But right now, if we're going to focus our energy right off the bat and have an immediate result, we don't want to waste our time on 4.7%. We'll do that later. We want to focus on the 50.7%. So why are we concentrating on the cost of goods sold first? Let's look and see why. We're going to look at the cost savings over time by focusing on the cost of goods sold. So let's look at year one and year two. Year one, we're going to implement some changes right away, and we're going to see our savings. So in year one, let's just say we have sales of $950,000. Our units sold, we sold 35,000 units to get that, and our sale price per unit is $27.14. And we have a unit cost per unit of $13.77. Now, I know I'm confusing you with these numbers. I may be getting a little too technical. Don't really worry about each one of these numbers and what they stand for. I just kind of want you to have a background as to what we're looking at. And really, we're going to be focusing on the savings. That's where we're going to focus our attention. But now let's look at this. If this is your business and you have sales of $950,000 and you decide in my inventory category, I am going to go ahead and focus on saving money there. And you were able to save 2% of your inventory. Now, how did you do that? Well, you called a vendor up and you got better pricing. You ordered in bulk. You got discounts for paying early. Whatever the case may be, you received a 2% savings. Maybe you found a new supplier. So we got a 2% savings on our inventory in year one. That's going to give us a total of $472,360 in inventory costs. And that's a savings of $9,640 because if you'll remember, if we looked at our cost of goods sold back here, we had $482,000 in inventory. So we've just now saved that 2%. That gives us a $9,640 in savings. Now, after that, we go and look at our wages. We also looked at the wages and we saw that, again, we still have the same sales, same units sold, but now our price per wages per unit is going to be different than our unit cost per unit. So now we're going to save 2% on our wages, cutting staff, reducing pay, whatever it might be. Running more efficiently, we save 2%. We see now a savings of $3,700. Again, this is year one. So we are saving now $3,700 immediately in year one. We continued through our expense category. Remember, we started cost of goods sold. We looked at inventory and wages. Now our expense, or for our payroll, is going to be a savings of $1,900. Now, if you notice, there's not all these different categories that we had for wages and inventory. So let's talk about this for a second. What's the difference between wages and payroll? This is going to depend on how good your accounting is being done right now, but your wages should only be anything that is directly related to producing income. That's under our cost of goods sold account. So our cost of goods sold is going to be anything that is directly related to producing income should be under cost of goods sold. Because every time we increase our sales, these numbers are also going to go up because they're directly related to producing income. Our payroll expense could just be our office staff, our accounting, whatever it might be. That's your payroll. That's not directly related to producing income. Sure, it's necessary in running the business, but not to actually produce income. If you have a business where you're selling bread and you're baking bread, if you start selling more bread, you're going to have to hire another baker. That baker is going to go towards producing income. So that's why that's under wages, cost of goods sold. So without confusing you too much, these numbers are always going to fluctuate because they're under the cost of goods sold. But the payroll is going to stay the same, because it's not based on sales. So we have sales still, we have our current payroll, we're going to save 2% on that. So 2% across the board savings, we're going to save $1,900, but it's never going to fluctuate because it's not cost of goods sold. With these savings of 2%, we now have a total savings of $15,240. So by year one of implementing these strategies for just these three categories, you have now saved $15,240. And that's not savings, that's money to your bottom line. Remember, increasing income without increasing sales. You have just increased your income $15,240 just by cutting 2% on these categories.